Hi, and welcome to today's Tax and Business Matters. I'm your host, May Watson. Let us continue our discussion on the most overlooked tax deductions. Alright, let's begin. Number 9 on our list of the most overlooked tax deduction is childcare credit. It's easy to overlook the childcare credit if you pay your childcare bills through reimbursement account at work. Although only $5,000 of such expenses can be paid through a tax-favored reimbursement account. Up to $6,000 for the care of 2 or more children can qualify for the credit. So, if you run the maximum allowed by your work plan, you can claim the credit on as much as $1,000 of additional expenses you pay for work-related childcare. That would cut your tax bill by at least $200. Number 10, estate tax on income in respect of a decedent. It's all about the IRA or the individual retirement arrangement. A decedent IRA is an IRA that was owned by a person who has died, from which funds are distributed to its beneficiaries. There is a big tax deduction if you inherited an IRA from someone whose estate was big enough to be subject to the federal estate tax. Basically, you get an income tax deduction for the amount of estate tax paid on the IRA assets you received. Let's say you inherited a $100,000 IRA, and the fact that the money was included in your benefactor's estate added $45,000 to the estate tax bill. You get to deduct that $45,000 on your tax returns as you withdraw the money from the IRA. If you withdraw $50,000 in 1 year, for example, you get to claim a $22,500 itemized deduction on Schedule A. That would save you $6,300 in the 28% bracket. Number 11, state tax paid last spring. Did you owe tax when you filed your 2009 state tax return in the spring of 2010? Then, for goodness sake, remember to include that amount with your state tax deduction on your 2010 return, along with state income taxes withheld from your paychecks or paid via quarterly estimated payments. Number 12, refinancing points. When you buy a house, you get to deduct points paid to get your mortgage in one fell swoop. When you refinance a mortgage, though, you have to deduct the points over the life of the loan. That means you can deduct 1/30th of the points a year if it's a 30-year mortgage. That's $33 a year for each $1,000 of points you paid. Not much, maybe, but don't throw it away. Even more important, in year you pay off the loan, you get to deduct all as yet undeducted points. That's because you sell the house or refinance again. There's one exception to this sweet rule. If you refinance a refinanced loan with the same lender, you add the points paid on the latest deal to the leftovers from the previous refinancing, and deduct the amount gradually over the life of the new loan. That's about it for today's Tax and Business Matters. Join me again next time as we continue to find out more about the most overlooked tax deductions. You can visit us online at www.howtodouryourowntaxes.com. Once again, this is May Watson, saying, "He who hesitates is lost." Till next time, goodbye for now.